He's making videos of this presentation as well. Yeah.
This one? Yeah.
Sure.
Yeah. Thank you.
This guy had shared the screen. Okay, take it away.
Okay. So hopefully this works. Okay. Yep. So. So my project again was 10-year yield to maturity of Treasury bonds. I think I didn't include everything in that, so I don't think there's anything in that I don't think so. Okay. Okay, up here. Okay. So, yeah, that's fine. So, the point of this is that these are commonly used to model the risk-free rate, just using the 10-year yield to maturity rate. Obviously, with the full year yield curve, you can kind of back out information about even recessions if you compare that with the 3-month rate, or in general, if you compare. If you compare like a longer yield to maturity to a short one or something like this. But for this, I'm just backing out the 10-year rate for the US Treasury. This is a bit of kind of the financial background of this. You have the actual bond price sold on either in the Treasury auction or in the secondary market, and then you have kind of a sum over all of the different coupon payments, and then you have the face value, and both of these are discounted by this yield to maturity here. And all this is to kind of show, you can kind of see that, this is kind of this very messy function relating to YT. But, kind of because we can back out this YT as a function of price and some of these other things which are fixed, and then we can model price. The idea is we're going to model price based on a bunch of our macro variables. So the general idea is we're going to try to model kind of chain this together and model we should be trying to model the yield to maturity in terms kind of more directly of these macro variables, like a time series thing. So it kind of breaks down like this, and I got a lot of recommendations both from this class and a couple other people of things to use kind of for those macro factors. Some of them were inflation, interest rate, treasury pensions, DXY, the relative value of the dollar, and I think it's like the relative value of the dollar in the foreign exchange market, not with regard to any particular currency, which kind of its weight in the currency market. I guess I should have mentioned that for the risk-free rate, that's also important for the two-fund theory, for a lot of different portfolio theory models like NPT and WACC, weighted average cost of capital, discounted cash flow valuation, and things like this. So I used DGS10 from Fred. This is the main variable we're trying to model, and then I have a bunch of other stuff here, and we'll see how much these come up. I have the Fed funds rate here. This is kind of our policy variable. I have kind of our model for inflation. I have CPI. I think unemployment rate just as an extra macro variable. I have using this as a substitute for DXY. This is the closest thing to Fred, TWDX. I have the S&P 500 index, and then I have this to kind of look at business cycles, which doesn't look correlating strongly, which is what we kind of went over the class with the yield curves, right? That's kind of, it's not going to be as strong as the actual yield curve varying, but the 10-point moving, there's a bit down here, you'll see it is actually kind of strongly correlated.
I have a question. So the P is the price of the bond,
Yeah.
right? And so you are discounting the coupon rate as well as the principal from the end of the payment.
Yeah.
And then so you're forecasting the YT, which is a vector of
Yeah.
multiple macro variables. So two questions. Are you doing this separately for all of these macro variables, or are you creating some sort of...
I'm not involving the price directly. The YTM is kind of backed out, and in the FRED data, what we get from FRED is actually this YT directly. So we don't actually get the PT from FRED. This is just kind of the background, because and I found this a little, when I was going through it, a little confusing, and I wanted to kind of share.
It's confusing because one of the YTs that you listed is a 10-year bond. And so I'm a little confused because if PT is the bond price, then YT, if you scroll a little down, the first on the vector of macro variables is the 10-year yield.
Yeah, I think in the literature I saw it like internal rate of return, because this is also I think not just
It's
the
the
option
same
price,
formula.
but the secondary price. So I think it's an implied term similar to like how you get implied vol from the Black-Scholes, where it's just like it shows kind of the market's valuation of their thought process of risk, or they're thinking on like economic growth and future policy and inflation and things like that.
I guess my question is like, is this for a particular bond price for a particular time period?
So the FRED data is going to be this YT term, but it's stuck at a constant 10-year maturity. So it's we're kind of following, I guess you call it, is this technically panel data instead of longitudinal? We're always like only looking at like the yield to maturity on a 10-year bond that was issued like today, and then tomorrow when we look at we want to look at a 10-year bond again.
Okay, got it.
Yeah, I
You
think.
can keep going, yes.
I
I think I understand what you mean.
Yeah, in the FRED data, it says market yield on U.S. Treasury securities at 10-year constant maturity quoted on an investment basis. I don't know if that makes anything clearer.
Yeah, it kind of makes sense. The only confusion was if you scroll down, like one of the first
Similar.
the
They're
first
similar.
thing you say is the yield. Keep going. The macro variables, the list. Keep going. That the first
Yeah.
one, DGSN.
Yeah.
Like, so I was confused how that
The
relates to
exchange
the
rate.
the
Yeah.
price. So that was my
Yeah.
main.
Yeah.
But
DGS 10
you can
is
keep
YT.
going.
I'm not getting the prices. Yeah.
Yeah, keep going.
Okay. So this is just busy work to get all of the. Yeah. Okay. Going variables that line up. So we do 10-year yield, inflation, policy shocks from the Fed funds, risk sentiments from the S&P, and then we're using the business cycle regime for model recession. One of the things that, it makes sense, but you have to show it is, I think it makes sense that this is not going to have really any seasonality, but I did an STL here, and you can see, like the seasonality here is like, I think that scale is pretty small. Yeah, so no seasonality. I think if you did it difference once, you get some seasonality. Regression produces, so I did R-squared for about 0.5% of the variance, so there's not really any seasonality. I used US rec, which is this NBER recession variable. to kind of model when the recession was on and off. And when I did this, I got that I have about an average of like a 2.9% yield in non-recessionary periods and a 0.8% yield in recessionary periods. So while it doesn't have a clear seasonality, it is kind of it does correlate with the recession periods and things like that. So okay. Okay. So in terms of testing stationarity, I do an ADF. I get -1.4. The P is about 0.8 for just BTS 10. And with the first difference looks a lot closer to stationarity. So I don't have any strong like intuition for why that would be, but all the test results show that the difference in the yield curve is fairly stationary. And you get for DTS, you use the ACF and the PACF. We have a sharp spike here, and then for the difference, you have the ACF and the PACF here as well. I basically tried 4 different models. I did an ARIMA and a VAR, and then I did an ARIMA and a VAR with exogenous, so an ARIMAX and a VARX. I think I wrote that I only did 3 here because I added the VARX after. But let's see. For the ARIMAX and the VARX, I kept all of these variables we just talked about. And I got this for the ARIMA forecast. For the ARIMAX, don't really know what happened here, but this is what I got. I'm not really sure why. I'm not. It could have been that I just showed something wrong. I'm not sure. For the VAR, I'm including all of the variables that we talked about. And the VAR has a better fit than the ARIMA, but I think the ARIMAX ended up being the best performer. This is about similar to, this is like a long for now. This is about similar to the ARIMA. Yeah, it prints out a lot when you ask it for. Okay. And these are the RFs. VARX. So okay. This is kind of the end of when I did the Young box for the ARIMA 011, the VAR, the VARX, and the ARIMAX 011. They're not fantastic because it's financial data, but the ARIMAX performed best. It's P of about 0.32. Is that amazing? No. Is it better than the other models? Yes. Am I like super happy with this? Not perfect, but there's some information I think you can get from this, and it seems like it did help to include a lot of these macro drivers, and thinking about its correlation with like business cycles and recessions and things. It kind of makes sense, and it also kind of makes sense that it's a little touchy. This data is not annualized. It is kind of I think from Fred it comes out daily, but I restricted it to monthly data to make it a little bit nicer. Get Fred monthly. Obviously it's going to be a little, but that's what I have here. And then in terms of conclusions, I do MA and RMSE and NAPE. They didn't end up printing well, but that's my
ARIMA has the lowest zero.
yeah, I don't I'm a little confused by that myself.
There should be a reason. And look at that, VARX 40, oh my God, that's too much. I
know.
believe that you added noisy variables like S&P and exchange rate. They are so noisy that may, change your prediction behavior. So, unpredictable. So that's the reason I believe that if you could remove those variables, you can have a better indicators to predict. And also, you need to think about adding the spread 10 years to 2 years. That spread would be helpful. But I believe that see that VAR and kind of ARIMA-X is like 180, if I'm not wrong. That's too big. That's the reason that because S&P and exchange rate kind of unrelated that may. I believe that it's nothing to do with the 10-year. Yeah,
One thing is, I think you did a very good job, but you put all the variables. I think you need some of them, not all of them. To increase your prediction, some of them it will reduce. You have to check it. The other thing, yeah, and then one thing, if you have, as Narimon said, some of them has a big shocks, you have to reduce your horizon when you train your data.
What was
If you
your
have
reason, to choose a S&P index and exchange rate? Because I'm agree with all of CPI, Fed Fund, 10-year market yield, all of them are reasonable, but what was your reason for choosing these two extra variables?
Yeah, that's a good point. I got some recommendations for maybe trying out DXY or seeing if the stocks were correlated, because there might be some inverse movement between stocks and bonds and things like that. But and I think I just kind of went with them without like a super strong economic intuition. But I think what you said makes sense. Yeah, that it's. Especially for driving, I guess it makes sense. Like unless they're like really strongly correlated, because there's some amount of noisiness to the interest rate data, but unless it's like really strongly tracked, that makes sense. That the noisiness in the DXY, the exchange rate of the S&P is like not helpful as opposed to like kind of wider macro moves.
Because that difference doesn't make sense for 118 or 46 is like it shows that the model did nothing to the data. That's the problem with choosing the variable.
Yeah, and it's weird given the Liam box is much worse.
Yeah.
So, yeah, I don't know. That's something that's really.
I
good.
think if you only reduce the very fluctuated one, and then if you want to remain those, if you like it, you have to train less years horizon without less shocks. For example, if you have a big shock in 2010, put it after that. But you have to see one by one.
No, I don't think that it helps. No, it's okay.
No, it works.
No.
I'm sure. If you have any shocks and put your train after that shock, it will reduce that shock. And
it needs to choose. Choose variables that have a good co-movement. It doesn't matter if it's positive or negative. It doesn't matter.
No.
Because
I mean something else. If you have any shocks, because for example something happened and it comes like this, it will reduce the accuracy if you put all of the period. You have to reduce that shock, and after that train it. This shock, it will reduce your noise and reduce your forecast. I'm sure. So you have to reduce the horizon. If you have a big shock, you can after that train it. But why you have to put very noisy thing in your data? But if you very persist to use it.
I think this this variable is very volatile.
Especially S&P.
Yeah, S&P.
And,
Oh,
and
yeah.
these models will not do a good job.
No. That it show 180.
You need to use a GACH model.
Yeah.
Which
Wow. Oh, yeah.
for
Oh.
volatility.
Wow. Yeah. Oh.
But I was kind of trying to understand, like, your focus, the intuition, or actually your approach. Were you trying to make a forecast for using the data up to now and forecast from now to a couple of days or a couple of weeks ahead? What was the intuition like? Did you have edge steps, number of edge steps in your forecast for EPS 10?
Remember.
Let me make it
My,
Let me explain
horizon.
how I understand. Maybe you can
H is 12 here.
be able to.
If you come down, here, 12, no, okay, a little bit, yeah. Here it is. No, I mean it has an edge. A little bit up. A little bit more. Here. Frequent edge is 12.
But 12 of what?
12 of whatever it is, it's day or month, I don't know.
That's my question. What is
August.
it?
I'm going to be honest, I was struggling with the R a little bit for this project, so I don't, I was flying a little blind. I'm not 100% sure which this was.
And this ties to my first question of T, like what is T? Like if you go back to that equation, why T? What exactly is T?
The formula, the equilibrium.
Yeah, in that
I
equation.
believe that if it's using the 10-year, it should be, I mean, for the sigma, it should be 1 to 10.
T,
and T
yeah.
should
T
be the
the year.
10-year treasury. If I mean, logically.
So that's the point where I'm confused.
Yeah.
Because if you go to the equation, DGS 10 is a yield.
Yeah.
Yeah.
And the way it's
10 year.
being framed, it's as in the secondary market. I think that's what you say is the secondary market. You can buy a 10-year bond anytime.
Yeah.
So that information comes in every second. You can every second.
The face value also
The face value changes
different.
every second.
Every second, yeah, you are right. You
So
are.
is T second by second? Are you forecasting every second, or are you forecasting every day? Is it an average for the whole day, or maybe for the whole month, like averaging the
So I think the
price
Fred
in the secondary market for the entire month? That's my point of confusion.
the Fred data comes in daily, I think.
So it's every day. So T is day.
Yeah, I think for this project I tried to, and maybe that was actually like the wrong thing, but I tried to just model it with monthly data instead to try and get, I guess some of the but I guess maybe we wanted some of the finer detail, and maybe that caused like problems with my data or something. I'm not sure. But
Yeah, I mean, if I can understand that, if I can know like your frequency, then I can.
oh yeah, for the
Inter-
data, each
intervals.
monthly.
So T is.
T is monthly. Yeah.
Yes.
So it's averaging through the month.
Yeah, get Fred monthly. I grabbed monthly for all the data. So
Okay, I see.
So like when I generated the ACF or the DACF for the time series or whatever, I had like frequency as well.
And what data did you use? Like, what's the training data? Like, what point did you start?
I guess I went back pretty far. I don't
and where you ended.
Oh, and
Should it maybe start in the first?
You can
of
show
the-
me, there's a graph that was showing
Time,
prediction intervals, and it was like not very well aligned. I can see maybe from that. The
yeah.
one that had confidence interval, prediction intervals. Is it this one?
Yeah. It's
Okay, so where does it end? Like,
26. Oh shoot, yeah, it's 2027. I guess it stops at 20. I think it stops at 2026.
okay.
My goodness, I think that stops at the end of 2026. I think. Yeah, like I said, I'm not perfect with all of the R stuff, but so I think this is 2026 here. Yeah. Or it looks like I might even go a little bit into. No, this is so these are 2.5 years. This is a year, 0.25 year. So I guess this is about. Yeah. Okay. That looks like you started 2026 or like February or March or something. That looks like what this is.
Yeah, so I think for this project, the idea was to try and decide on a model based on the data that you have. And so we are trying to use the training data, and we're trying to use some of the techniques that we've learned to be able to select a model. And so everything we've been doing, looking at SEF, PSEF, trying to figure out what is the appropriate model, trying to look at auto ARIMA, trying to identify seasonality, and see if we need to use ARIMA, and then finally trying to look at what are the different variables that whose lags we can use to inform our outcome variable. And I think you've used theory to kind of pick out some of the important variables that affect the bond prices. But then with VAR in our previous classes, you get to use this unique model to help you decide how far back to go for the different variables that you select, right? And so the idea is with this process, you want to select a particular model and have a good reasoning behind why you selected it, right? So here, one of the things would be to just pick out a couple, two variables, and then use the VAR model and try to see whether that improves the error, the RMSE or the MAE, trying to see how you can reduce that error as much as you can. But as we mentioned from the beginning, when we're looking at the stock market or the bond prices, the GATT model can do a better job because it's just too volatile. The ARCH model as well. It's too volatile, and this model such as Black might not do a pretty good job. So that is kind of the takeaway from this process. Do you have any reflections of how you could improve either limitations or explain why we have such a big error for this?
Yeah. I think the data has a high volatility. I think, yeah, I definitely could have used GARCH. I don't know, I don't think, like, that, yeah, that makes some, yeah, it's a system to take on my part. It's high volatility data, GARCH is kind of made for it. Yeah, I definitely could have, looking back, I definitely could have, tried with just two of the more stable variables and taken a look. Maybe I didn't need to necessarily limit myself to monthly data. It might have been helpful to have kind of the smaller, smaller details, especially if I'm going to be forecasting on a smaller window or something. So that could be useful as well. I know from Karanjit and a few other people's presentations, modeling things like COVID and like the 2008 recession and things like that with kind of like synthetic or external variables that match that can be helpful. But I think I also kind of used that by just using use of the recession dummy variable. So I think that kind of took care of that. Aside from that, probably there could be some better, more consistent data handling with R. I'm still a little shaky with that, but I think those are the main points in terms of what could make the error smaller. The error is probably going to be bigger than some of the other projects because it's financial data, but I was hoping that because it's like Treasury bond, like long-term maturity financial data rather than some like crypto something rather, that it would be a little stable enough to do some econometrics on it. I think there was some stuff that I got out, but I think I could definitely make those changes that would improve the forecast.
Yeah, it's not as volatile as crypto, but still volatile nonetheless. Because investors who are in the stock market can choose to, especially those who are more risk averse, they may choose to switch anytime from the stock market to the bond market, just because, especially like when the stock market becomes too risky. So in the secondary market, the bond prices move in a volatile manner, just as the stock market. Yeah, because of that relationship. All right, good job.
Yeah.